Our very first speaker is Samantha Emery from Glenhawk, who we haven't met actually because Samantha's only actually come on board with us in the last 3 weeks. We had Pete Turner previously, who I've known for many, many years. So this is what you should have received this morning. Now, a couple of you have actually given us your wrong email addresses. So there's a good chance you're actually not watching anyway, because you wouldn't receive any notifications. I've sent out all the product guides for all the lenders that are presenting today. And a couple of you, they've actually bounced for a couple of you. So if you are watching this and you haven't had it, check your spam folder, first of all. And if you still haven't got it, if you email, don't email me because I won't be able to pick it up, but email the team. So email Kylie@specialisthub.co.uk and she'll get those over to you. But you would have received this morning. As you say, this is a dual branded Glenhawk and one of our brands, Specialist Bridging Finance, the product guide. So a little bit about Samantha, first of all. Samantha, a BDM for Glenhawk covering the Southeast, brings with her over a decade of experience in the financial services industry, most recently at Together Money, where she was Regional Development Director for just under 3 years. Prior to here, Samantha spent over 10 years at Barclays Bank working across a number of roles, most notably as a Premier Relationship Manager, where she was looking after nearly 700 high net worth clients. Samantha is a social butterfly and loves nothing more than meeting new people, as well as spending time with her existing connections across the professional sector. She gets a real thrill from seeing clients achieve their dreams using property finance, whether that is buying a first or 100th investment property, a new or rundown commercial premise, or raising money to further their business. When not working, Samantha can be found enjoying a country pub lunch or a windy beach walk with her family, including a very hyperactive French bulldog. And Samantha's interesting fact, Samantha has been on television twice, and this is actually very interesting, and I'll explain why in a moment. Been on television twice, once as a baby in a Daz advert, and in November 2019, she starred in Bargain Hunt along with her mum. Which she said was great fun, but extremely cringe. The reason it's interesting is that I mentioned Pete Turner, who was our previous BDM, who was also on television when he was a child, and he was in a Persil advert. I don't know if you're aware of that, Sam, but yeah, he was. And when he presented last time, I'd actually managed to track down a photo on Google of Pete Turner actually on the Persil advert, which he wasn't aware that I had. So, but Sam, I did check, and we couldn't find you on either Bargain Hunt or Daz.
I'm very glad.
Yeah, but there's plenty of time. So next time you present, we might come up with something. You never know. Right, Sam, it's all over. It's over to you. I'll see you in about 20 minutes, but I'll be watching. So if there's any problems, just give me a shout, and I can do whatever needs to be done. It's all yours.
Thank you very much, and thank you for having me. So, yeah, today what I'd like to do is just give you a little bit of background information about Glenhawk, but mainly here to talk about all things bridging. So without further ado, Glenhawk was founded in January 2018 by a gentleman named Guy Harrington. Guy was actually a property developer himself and found that he was using bridging finance for a lot of his projects, actually still does, and still uses other lenders he's not able to lend to himself. But just felt that perhaps there was a bit of a gap in the market for somebody who was a little bit more transparent and a bit more customer-centric. So hopefully, as we're going through, some of that will come out and you'll be able to see that. But what I'd like to do initially is talk about debunking the myth of bridging finance. So what we mean by that really is, obviously a lot of you will know that to some people, unfortunately, some people still out there, bridging is a bit of a dirty word, which is completely understandable for what's happened, previously. I think when bridging first came out, it was obviously a bit more mainstream. Banks were doing it, and then unfortunately some of the practices weren't always ethical. Banks pulled out, and then it just became a bit of a dirty word. But we are seeing now a bit of a full 360 in that space, and finding that actually obviously the bridging finance now that is out there is a lot more customer friendly, is more transparent, and how it should be really. So it's not just, bridging finance doesn't just have one use. Some people always think it's too expensive, whereas maybe that might be historic data that they're looking at. The bridging is always just about speed, or that it's the last resort. So obviously a lot of the time in bridging, there is definitely a speed element to it, but it's not always that. Sometimes you may need just some flexibility, or it's just the right product in that space. And actually we're finding that instead of the last resort, it's quite often becoming first choice. So I just want to go through some examples of typically where we see bridging and why it fits in that scenario, and basically what Glenhawk can do. So I will give a couple of really brief sort of case studies as how we've helped him each of these. So auction deadlines. So that's probably pretty standard, to be honest. I think most people are aware that if you buy at auction, it's highly unlikely that you're going to be able to finance that property with a high street lender. They're just not able to complete in the time. Now, there are some specialist lenders out there who are able to do long-term mortgages in that time if that's the right product for you. But usually bridging is most commonly used in this space. And so a recent example of this for us was a residential property was brought at auction. It came to us with 11 days to go, for even though it was 28-day completion. But I think quite typically sometimes customers will try and find a way to make it work themselves before they then approach a broker to help. So we ended up coming across this with 11 days to complete. We were able to do 75% of the purchase price at auction. And actually the client needed as much out as possible and had the funds there, so we were able to service as well. So one of the things that we'll kind of cover off a bit later is where we're able to offer serviced and retained on our unregulated bridges and how that works, but I'll kind of go over that a little bit later. So marketing loans, equity releases, development exits, they've got a few different names, but we're seeing a massive increase in those in the market at the moment. And I think that's probably got something to do with COVID, where there's been obviously delays in terms of whether that's getting hold of materials or having the staff or just being able to sell the properties in that time. So again, we're coming across a lot of these, and it's something that bridging fits really nicely for, especially if that exit is going to be sale, which most commonly in these development exits it is. So one of these we did recently was actually a pub that had been converted into 5 residential properties. The client had come to the end of their term with their current development finance, but they weren't quite there. So they did have a couple of properties that still needed like kitchens, bathrooms, just internals. So we were quite happy at that point to step in and give them the funds to clear out their current lender and also the additional funds to finish those works. And then that also gave them the time to then finish them off and be able to sell the property. So one of the things that we do at Glenhawk when it comes to development exits is we don't have a separate product like some others in the market do. Reason being is we're quite happy. We know that, you know, there's sometimes a premium to pay when it comes to new build properties, but we're quite happy with that scenario. We're happy to look at still 75%. We're still going to work off the open market values. So we don't feel the need to be restricting those or restricting LTVs in that space. And that's the same if it's commercial or residential property. So uninhabitable properties pretty much is exactly what it says. So that could be, you know, depending on who the lender is, possibly the high street, where if the property doesn't have a kitchen or doesn't have a bathroom, it could be deemed uninhabitable. It could just be that you're carrying out works to the property. And again, bridging then fits quite nicely in this space because most bridging lenders, including Glenhawk, are quite happy to look after those properties. Until obviously you've got them for wherever they need to be, and then you're able to exit at that time, whether that be to refinance onto a high street, or if you're actually just going to be selling the property at the end of it, then bridging would be the right thing all the way along anyway. And again, that can be on commercial or residential properties. So commercial to residential conversions, again, something that I think the whole of the market is seeing a large increase in at the moment. Largely probably because of the PD changes that came into effect in August, where you're now able to convert some commercial properties to residential under PD. So this is something that's quite widely out there, I suppose, at the moment. And again, something that bridging fits really nicely with and that we're happy to help with. So a recent I've seen of one of these was a large office block was being converted into 12 flats. Under PD, we were able to do 70% on day one, fund 100% of the works as well. And that, again, doesn't have to just be commercial to residential, even though that quite commonly that's where the bridging is used at the moment. Also, if you're doing commercial to commercial, we're quite happy to help. So we've recently done a warehouse that was being converted into offices where we can fund on day one plus the works as well. High demand on unique opportunity. So basically it just means being able to behave like a cash buyer. I think maybe that's typically more in the regulated space sometimes, obviously regulated, unregulated as well, sorry, but we're seeing that in the regulated space where, especially I suppose when we had the stamp duty, maybe not so much now, but when we had the stamp duty, it was absolutely crazy where, you know, properties were coming on the market and then being sold same day, and you needed to be able to have that flexibility to say that you were a cash buyer, and the bridging just kind of enabled you to do that. I know that we did one recently which was a bridging and regulated bridging, which completed in 8 days. And obviously, you're just not going to have that if you weren't using bridging in that space. Chain collapse, again, probably most typically regulated in this space, where we've seen a number of these recently, where I think that people were hoping to complete within the stamp duty timescales and unfortunately weren't able to, and then have pulled out. Whereas we've got clients who actually are not in that mindset. They don't want to pull out. They still want to be able to purchase that property, but they've now obviously lost their buyer. So bridging fits perfectly in that space. And obviously you'll need a regulated bridging if it is for a regulated purpose. Discount purchase price below market value transactions. I know we would all like to come across these, but there are a lot of clients out there who do come across them. Maybe they're buying a property prior to it coming onto the market, or possibly they're a tenant in a property already, maybe a commercial tenant, and then they're able to purchase that property below market value. So I've had conversations with quite a few brokers previously about, oh, you know, it says it's below market value, but once the valuation actually comes in, it always comes back at the purchase price. So I think that that is a lot to do with the lender and maybe how the valuation is instructed. But at Glenhawk, this is something that we're really happy to support, and we do quite a number of. The recent scenario for this was, we had a property valuation was 360,000. Client was buying the property for 280. Valuation came back bang on 360, and we were able to then 90% of the purchase price. And that just meant that, you know, a few months down the line, depending on which lender he was going to, would depend on whether he needed to wait for 6 months or not. He was then able to refinance that out on a term at the full value. So just perfect, I suppose, scenario for where bridging can be definitely a first choice use. Planning delays. So this could be if you're purchasing a residential property or commercial property, but you're going to look to make some changes to that property. So maybe you're buying a residential that you'd like to convert to a HMO. Maybe it's in an Article 4 area. Maybe you need planning. And again, bridging just fits perfectly in this because it enables you to make the purchase. And then obviously, once you've got that planning or whichever in place, a lot of lenders like ourselves, you'll be able to then borrow the funds for the works to carry that out as well. Or depending on how heavy that's going to be, maybe you need to move on to a development finance. Also, another place where we see this being used is land with planning. So again, I mean, the most recent example for ourselves that I actually lent on a piece of land in Manchester, and that had planning for 6 detached residential dwellings, semi-detached residential dwellings. But the client had decided he actually wanted to make that 6 detached, I suppose, obviously to maximize the profit there. So we lent the funds for him to be able to purchase that. And then he's obviously at the moment, he's in that process of getting the amended planning for the detached. And once that's approved, the exit will then be onto development finance. So again, bridging obviously fits perfectly in that space as well. Gifted deposits. So gifted deposits with some high street lenders, they may put stipulations on how much of it can be gifted or who it's gifted from. Does it need to be immediate family? We're quite happy with looking at gifted deposits. It can be 100% gifted. We have had scenarios where the deposit's been gifted from an auntie or a cousin. And again, I think, like we say, a lot of bridging lenders will be relatively comfortable in that scenario. And then it just means that whoever they're going with at that time, whether it's 6 months or however many months they need to wait, but when they refinance out at a later date, then they're able to refinance out at the market value as is, and the gifted deposit doesn't become an issue anymore. Non-standard construction. So again, it's pretty much what it says. So you've got some of your timber frame properties, things like that, where bridging fits really nicely for, and we're really happy to support. I suppose the main thing to be considered in those types of situations would be the exit. You obviously wouldn't want your client to be stuck on a bridge, and the same for a lender. They don't want anything to be stuck on a bridge either. So it would just be making sure where you'd be able to exit or who you'd be able to exit to at the end of that. And obviously there are a lot of specialist lenders in the market who are more than happy to do term loans on these type of non-standard construction properties, but it's just something to consider. Credit profile. So if a client just needs a little bit more time, so maybe they need some time to improve their credit. So maybe in 6 or 9 months time, some things will have come off their record, meaning they're able to get better rates on a long-term product. Or maybe, it's just they're going to need to go to a specialist lender or whichever at that point. So We're quite happy to look at some adverse credit, whether you've got sort of defaults or CCJs. We'll probably want to, see reasons behind them or that they've been satisfied, but it's something that we can help with, and other bridging lenders obviously in the market as well can have a look at. Again, exit would need to be considered at this point. If it's sale, then obviously, it's not really so much of a concern, but just making sure that the bridging term is going to be long enough for them. We actually do have a product at the moment as well that it's a credit builder. So it's something relatively new to Glenhawk, which you wouldn't have seen on some of our product guides, where if somebody has got really poor credit and they're a bit stuck, then it's just being able to find a way to get out, I suppose, just for the time being. So we did one recently where a client had 6 missed payments on their mortgage in the last 2 years. So it just meant that they were really stuck basically on where they were able to go to. So we were quite happy to assist, and the exit was going to be sale anyway, but that client just needed those funds now. Non-UK nationals. So we're quite happy to help in this scenario as well. One of the things that we'll need is that they do have a UK credit footprint, and we like them to own a property in the UK already. So obviously it's unlikely to be a residential home, but that they've got something here just to show some sort of background. But again, some other lenders may not need that at all. So bridging fits perfectly in that scenario. As you may have gathered from what I've been saying, we do offer regulated and non-regulated bridging. So I'll just cover kind of a couple of really brief differences, I suppose, between the two in terms of the product set. So with our regulated bridging, we do have a product guide, which has a rate card on it, which hopefully you will have seen. If not, I'm happy to send it out, or it's on the website as well. And then obviously the rates are set as per the LTVs. So minimum terms are 1 month, maximum term is 12 months, and all of our regulated bridges are on a retained basis. On our unregulated bridging, we don't have a rate card. So we have obviously a range, but all of our bridges are priced individually, and that will be based on the covenant of the client, which is something that's quite important to Glenhawk, but also the property itself. And the LTV. And as I say, all of our rates are between 0.65 and 0.85 anyway, which you would have seen on the product guide. So there's a range there. But if you've got a client who's got a really strong covenant and we're lower LTVs, we're going to be at the end of that. And one thing that's probably worth noting as well is in terms of our commercial bridging, most people, I suppose, will assume that we're at the higher end of that. Well, we're not. So our 0.8 to 0.85 is probably typically used for sort of your land with planning, your smaller deals, or your second charges, and everything else is below that. So please do give us a try in terms of looking at rates. And on our unregulated, as I mentioned previously, we do allow serviced. So in terms of when we're looking at service, we don't need to see like P60s or pay slips or SA302s. We'll literally just want to see the last 3 months bank statements, and we'll look at the regular income that's coming in and the regular outgoings. And again, we can be really commercially minded with this. So I have a client that we had bank statements in for recently, and there was always a balance of sort of 85,000 in there. So we could clearly see that the serviceability was there. So we'll just use a bit of common sense in those scenarios as well. So as I said, obviously regulated bridging, you would have seen our product guide come out, and we've got the rate card for that. But just to keep couple of key points to note. Actually, our maximum loan size is now 2 million, not 1.5, but that's literally just happened. So hence why this isn't up to date. So apologies for that. But everything else up to 65% on second charges, 70% on first charges. And we're quite happy to do a mixture of the two. So a first on a new property and a second on one they've already got. We don't do standalone seconds on our regulated bridging, but like I said, we're happy to look at a mix of the two, and we're really happy with refurbs and works being carried out to the property. So if you've got even something that's got planning, or they've got property already and it's got planning, or they're buying a property with planning and it's regulated, it's something that we're really happy to look at. So a few key notes, I suppose, as to why you would use Glenhawk. So as I mentioned at the beginning, Guy obviously set up Glenhawk because he wanted us to be more transparent and customer centric. So we don't charge any admin fees, any exit fees, any early redemption fees. The only fees that will be on any of our bridges is a 2% arrangement fee, as to which the prop fee is paid out of. And then you'll have your title insurance, which every bridging lender takes, which is usually sort of £300 to £400 mark. But nothing else, no other fees at all. You always get to speak directly to an underwriter. So any application that's in with us, the broker gets direct access to the underwriter. whether that's email or over the phone. None of our underwriters are scared of the phone. They're more than happy to have discussions with brokers. Obviously, your BD will stay in touch with the deal throughout as well, but it just means that you get that direct contact with the person who's making the decisions on those cases. As we mentioned, we're happy to assist up to 90% of the purchase price for any below market value transactions, and arrangement fees are obviously 2%, and there's nothing else on there. So that was all. Obviously, if you've got any questions, please do feel free to type them or shout them out. Or like Tony said, we've got a couple prepared that we can always use.
Okay, thank you, Sam. That was brilliant. Haven't got anything coming up as yet, so here we go. I think you've already actually answered one of these, but I'll ask it anyway. So how do you price deals?
Yeah, so as I kind of obviously covered briefly, where we're pricing everything is going to be on an individual basis. So just to give possibly an example, if we're looking at a residential property and we're doing 75%, and you've got a client that maybe owns their residential home only and it's geared at sort of 60% LTV, they'll be given a rate. Whereas if the same client has got a really strong covenant in the background, they possibly own 10 buy-to-let properties, there may be a tiny reduction. It will only be sort of a couple of bips, but it really is on that strength of that client. And one of the things that's worth, I suppose, us mentioning as well, anybody who deals with Glenhawk will always know that every inquiry we look at will always ask what else is in the background. And every single AIP that's issued goes through either Nick Hilton, who's the MD, or Jamie Pritchard, Director of Sales. And the reason why we do that is because we've heard stories in the past about sometimes with other lenders, something will get to application and then, or even later, and somebody else will pick it up and say, oh, I don't like that LTV, or I don't like that rate, or I don't like that property. So we make sure that that never, ever happens at Glenhawk, which is why they always obviously go through one of those two. So every AIP that's issued from us, that is exactly what you're going to get. It's credit backed.
Okay, we just had, you have to forgive me because my glasses are either a little bit dirty or my screen's a bit dirty. G1 has said, for Glenhawk, do you have a panel of surveyors you refer to? Look, he's looking for an auction purchase funding on a buy-to-let unit. Client wants to get the valuation done before the auction day.
Yeah, so we do. We have a panel of surveyors that we work with directly, and then we also have a panel manager, which is method that we can use if needs be, or if the property is maybe a bit more national. So yeah, that's absolutely fine. I mean, what we would usually say, if a client wants to get the valuation done for auction, they're happy to pay for it, absolutely fine. We're more than happy to instruct that on their behalf. If they do want to do it themselves, we would just obviously suggest that we obviously have a chat prior to that, because one, we need to make sure that a surveyor would be happy with a readdress and there's no conflict of interest, and also that the right information is covered, because sometimes clients will go and get valuations done themselves, and then when we look at a readdress, actually they haven't given any information to be able to lend on the property. So just something worth having a discussion about prior.
Okay, we have got somebody typing something at the moment, but I'll ask the second one you said, Sam, which is what niches would you say Glenhawk have?
Yeah, so I would say probably the biggest one for us would be that we work off open market value. So and we use that for everything. So I mentioned obviously I mentioned in the presentation that we'll use that for our development exits as well, whereas possibly some others won't. But we also work off open market values for commercial properties as well. Whereas I think a lot of others work off maybe 180 or 90 days, but we don't use them. And it just means that either we're possibly getting a bit more out day one, or if they don't need maximum, then the LTV is a bit lower. So then the rate comes down. I suppose our below market value proposition as well. So it is genuine. We do quite a lot of them. So we're quite happy in that space. That's probably a niche. And then I suppose the last thing would be what I just mentioned on the AIP. So if you get an AIP from us, that is exactly what you're going to get. We're not going to change that unless obviously your valuation is different or something comes up at legals. We're never going to change your rate or your LTV. What's been offered is what's been offered. So.
Okay, I'm going to say two things about Glenhawk. First of all, the fact they do regulated bridging as well as non-regulated bridging means they have obviously certain standards that they adhere to across the board. It's not just they don't have a different way of working for regulated and then rip the client to pieces on unregulated, like some lenders do. And we are very careful who we bring onto panel, purely because what we don't want, because we deal purely with introducers, what we don't want is we arrange something for a client and we find out then there's lots of nasty little surprises down the line that are hidden in sort of like page 26 of the terms and conditions that no one ever actually gets to read. So they are a lender that I really, it's the type of lender I would sell a product to a member of my family, for example. That's really the benchmark I always try and use, because they're not there as a rip-off company. And there are some out there, unfortunately, who, we've all got horror stories when it comes to bridging, let's face it, but there are some out there that I wouldn't touch with a barge pole. I really wouldn't. Second thing I'm going to say is that we are very lucky to have packager status with Glenhawk. So quite simply means that if you come via us at Specialist Financial or Specialist Bridging Finance, in this case, you get to earn the same as you would as if you went direct. Now, the added advantage of that is, obviously, I've known the staff at Glenhawk for quite some time. Sam just mentioned Jamie Pritchard, who's a Facebook friend of mine, known him for donkey's years. And so my situation is, if I have something I want to discuss, my staff will speak with Sam. I will speak with Jamie. That's nothing against Sam. That's purely because that he's my level contact, and he's the person I will contact. So as a company, they really are right up there amongst the best within the bridging market. So, and there are plenty out there that really are nowhere near the level that Glenhawk are. So give them a try, is all I can say, really. No more questions, Sam. So we're done. We're 4 minutes, 4 minutes early, which is fantastic.
Well done.
So it's been lovely to meet you. So this is the first time we've obviously met. You've only literally just come on board in the last 3-4 weeks with us. Lovely to meet you. We'll see you hopefully soon in the office when you're out doing face-to-face visits, as long as nothing daft happens over winter. So, but lovely to meet you. And thank you very, very much, Sam. Excellent presentation. Thank you. If you just wait, what my IT team will take you out as a presenter. I'll make you a delegate, and you can then obviously do whatever you need to do. You can watch the rest of it, or you can obviously do whatever you need to do. So, but we've had speakers in the past who've actually tried to close down the entire event because they clicked the wrong button. So, yeah, don't do that, please. So, Sam, thank you very much again. Okay, so right on our next speaker from Hampshire Trust Bank, Sammi Gilbank. So it's another Sammi, our second one of the day. This is our final Sammi. Okay, so yeah, Hampshire Trust Bank, who we are very fortunate, since their launch in 2016, we believe we still are their largest producer of business. We certainly were for the first 3 years. And once we've got a couple of fairly chunky cases going through that have now been offered, I would expect we are definitely going to be their largest introducer since they launched. So as mentioned, our relationship with Hampshire Trust, and there's Sammi, can you hear us, by the way?
I can hear you
fine,
can,
marvellous.
Yes.
Our relationship with Hampshire Trust Bank, I would say, is probably second to none. Because we've been there right from the start, and throughout. So, okay, so a little bit of introduction first of all. First thing is, you should have received this via email this morning. If you are watching and you signed up after 10 o'clock, one of you did actually spell your email address wrong, so you wouldn't have received any of the paperwork from me. So we're just trying to work out what you spelt wrong, but it's actually bounced back as doesn't exist. So we're just trying to work that out now. So if you haven't got it, check your spam. If you still haven't got it, then we'll make sure we get the right email address for you. Okay, so a little bit about Sammi first of all. I don't want to say Sammi's been around for donkey's years, but she's been around for quite some time, as you can see. So she started her career in financial services back in 1995 as a secured loan clerk for First National Bank, which is obviously the lender I have my embarrassing cricket story with. She's progressed through various roles over the years, from administration to underwriting, and has worked for other banks as well as direct brokerages on an advisory basis, and spent 10 years working for a packager. Sammi has seen many changes over the years, and the variety of roles she has held has given her an all-round understanding from a borrower, broker, and lender perspective. But it's not all work. She has a passion for music, listening, not playing. Sammi goes to many live concerts and loves the theatre too, something she, I should probably say, has missed in the strange times. She's probably overloading now. I know I certainly am on restaurants. That's why I can't get my bloody trousers on. But she's probably now back in the swing of it and seeing lots. And she lives all the way down just outside the New Forest, don't you, Sammi? So
I do, yes.
Which then leads on to the next one, which is she's signed up for the Walk 1,000 Miles in a Year challenge. All walking to be done outdoors, and she's currently on track, but a long way to go. How many have you done so far, Sammi?
I'm on about 775. So yeah, I'm
got that far to go then. Blimey, over 3/4 of the way through. So that's pretty good going. How many pairs of shoes you gone through?
On my second pair of trainers. So yeah.
Right, I'll put your first slide on. It's all yours. I'll see you in about 20 minutes.
Wonderful. Thank you, Tony. Good morning, everyone. As Tony said, I am Sammi from HTB, Hampshire Trust Bank. We are a specialist mortgage lender. Everything that we do is unregulated, and we're predominantly in the specialist buy-to-let and semi-commercial markets. We do a little bit of bridging, but I'm not going to touch on that today. Really want to concentrate on our specialist buy-to-let and a semi-commercial proposition. Everything that we do, all of our lending is unregulated. As we're going through the slides, essentially the presentation does reflect the true essence of what we can deliver in normal circumstances. A few changes to criteria as a result of COVID, but most of where we are now, with things kind of opening back up and everything getting back to normal, we're pretty much there, business as usual. But if there are any areas we're still not quite fully back in, I will mention those as we go through. Okay, so just a little bit about HTB. We've been around as a bank since the 70s, but the specialist mortgages division, which I work in, really kind of started to get going in about 2016. Very hands-on approach, very much a one person will look at your case and kind of deliver on that to take it through. So specialists, being one of our key accounts, do have dedicated members of staff to support them throughout the process. That starts with me out on the road to a dedicated lending manager and now a dedicated completions officer too. We always encourage our underwriters to speak directly to specialists. So if they've got questions or queries on cases, they will come to them directly to obviously give you the best service that they possibly can, knowing that they're speaking to the right person who can make the decision and move your cases forward. Okay. So just moving on to really where we see probably most of our business coming in, and that's on our specialist buy-to-lets. So we can lend up to £15 million per borrower, and that's either as one loan or across a couple of facilities. But once we get to 15 million gross, that is our absolute max we can lend. We can lend up to 75% LTV, but our arrangement fees can be added on top of that. So provided we've got the rental cover, we can go slightly beyond that 75% max. Currently, we don't have a maximum age. That's either at application stage or at end of term. We don't have a minimum income requirement unless your borrower is a first-time landlord, and I will touch on the criteria for those guys as we're going through. And we've got a very simple product range, so we only have 2 and 5 year fixed rates. It's probably worth noting, whilst we're talking about buy-to-lets, for ourselves as a lender, we do cover so many different property types, which other lenders may actually consider to be probably, more commercial. But with ourselves, everything that we do is very much. Oh, sorry, we seem to have jumped back to the wrong slide there. Everything that we do is very much broad, so it is very specialist when it comes to buy-to-lets. Bear with me a second. I'm just trying to get down to the next slide. Here we go. So, as I briefly mentioned, we lend on all different property types, but also as part of our specialist buy-to-let proposition, we lend to a whole host of different borrower types. So that can be your standard landlord, portfolio landlord, any size. There's no restriction on the number of properties within the portfolio, either that we can lend on or that they hold in the background. We do stress the portfolio in the background at 125% at 5%, but we've got no restriction on the number of properties we can lend on as long as we're within our 75% and 15 million max. We can lend to trusts and offshore companies, which again is slightly unusual. The offshore companies that we're lending to, what we are looking for there is for them to have an onshore beneficial owner. But typically we'll consider things like BVI, Isle of Man and Channel Isles. Brand new SPV, so no minimum time trading. So we can start the application whilst that's being set up in the background. As long as we get to formal offer and we know the company that we're lending to, we can then lend to that brand new SPV. Expats and foreign nationals is something very niche for us. We don't restrict on loan sizes or LTVs. There's no loading on our rates when we lend into all these different borrower types. So for an expat, no matter where they're kind of residing in the world, we can lend to them on their property back in the UK. And with foreign nationals, we can either lend to them if they're living in the UK, but they do not require to have permanent rights to reside, or we can lend to them if they're actually residing outside of the UK in another country, provided they have a UK footprint. That UK footprint could be not just a property, it could be a limited company, it could be a UK bank account. So something that we can kind of link them back to. And whilst we will consider most countries where foreign nationals are living, obviously there are going to be some rather high risk ones. So either we're going to have to do a little bit more due diligence when we're looking at those, or it might just simply be one that's too high risk. But if you contact the guys at Specialists, they can go through and let you know whether or not it's one that we can consider. With trading limited companies, interestingly, we can lend to any trading company. So it doesn't need to be set up with a specific SIC code. So it could be a builder's merchant or a plumber's merchant, any type of trading limited company. Obviously, we'll lend to individuals, so they don't have to be one of these other entity types. And we are considering lending to first-time landlords. This is probably where we are slightly more restrictive on the property type that will allow for first-time landlord to borrow against. Again, we can go to 75% LTV, but we are restricted to single family dwellings, up to 4 units under 1 freehold title. And as I move on to semi-commercial, we can consider first-time landlords for semi-commercial too. They need to be residential homeowners, and they also have to have a minimum income requirement of 25k, but that is per household, not per individual. So if you've got joint application, if their joint income is 25k, then that will hit the mark for us. So with all these different borrower types, there's a whole host of different property types that we can lend on as specialist buy-to-lets. Again, I mentioned that some lenders may class these more as commercial, but for us, this is our standard buy-to-let range, no loading to the rate, so it's the rate card that you will have been provided for buy-to-lets and HMOs. We can lend on holiday lets, which, as you can imagine, are really popular at the moment. What we're looking for with the holiday lets is for them not to have any restrictions on the use. So what that means is potentially it could still be let on a standard AST. Should we enter into some other kind of lockdown, it means that that property can continue to generate income, which obviously safeguards the client and obviously safeguards ourselves. New build flats, we've got no issue lending on new build flats as long as they've got the correct warranties in place. No restriction on the number of floors within the block. All I would say is with new build flats, especially if they're city centre locations, just be mindful of any high service charges, because we do net that off from the rental income and we'll work off the net rather than the gross once the service charges have come off. Flats above commercial, we can lend no matter what the commercial is underneath that residential flat. So if you've got things like restaurants, fast food outlets, even casinos, bars, etc., we're just relying on the valuer's comments to be positive and there to be good demand, but we've got no restriction on what's either underneath, next door to, adjacent or near to the property that we're lending on. So again, that's something else quite nichey that we will do for you. We can lend where there are sitting tenants in the property already, so it doesn't need to be vacant when we actually take the property on. We can consider doing some regulated tenancies on a case-by-case basis. I think one of the ones we have done of late is for the guys at Specialist. It was a great scenario because we had a multi-unit block, we had one regulated tenancy and occupancy, but we had enough rental from the other units within the block to be able to cover the loan, because I'm sure you're aware quite often the rental on those particular tenancies is lower than the market would be. That brings me nicely onto low yielding properties. So we can consider top slicing where the rental doesn't quite cover the loan that they're looking for, and we can take any type of outside income provided it's UK earned income, so we can't use foreign income for our top slicing, but essentially we could look at employed income. self-employed income, or surplus income from the rest of the portfolio. So if you had a landlord that's got properties in the south that are lower yielding, but some properties in the north which potentially could be much higher yielding, we can take that surplus rental and add that back to the deal to get them at the level of borrowing they require. DSS tenants. So if you've got DSS tenants in situ, provided they're either on a housing benefit or potentially income support, we can look to lend. We don't lend where the tenants would be classed as being vulnerable in any way. So we can't lend where there are vulnerable tenants in the security. Freehold blocks, so that's your multi-unit freehold blocks. Any number of units within the freehold, we're not restrictive at all. Generally speaking, if we're lending on a single unit, we're looking for a minimum square meterage of 30. London and the South East, we can consider some individual units with which are slightly smaller. But if we have a scenario where we're lending on a multi-unit freehold block, if all of the units are smaller than 30 square metres, we can consider lending on that, because potentially we'll look at it as an investment where those individual units would not be sold off individually. Is a unit that a multi-unit block that's being held as an investment. HMOs, again, we've got no restriction on the number of rooms within the HMO, so we can really do any size as long as they're an experienced landlord. They don't need to have HMOs already, but they do need to have buy-to-let experience. And what we're looking for there is for the HMO to be supported by the correct planning and the correct licensing. So as long as that's all in place, then we will be happy to consider any size. We can also look to lend where on any of these securities you don't have a standard AST in place, so we can look at commercial leases and other agreements, so we're not just restricted to lending on ASTs. And with our holiday lets in particular, if the property has been used as a holiday let and run as one for the last couple of years, we can look to take an average high, medium and low seasonal figures, and that's the rent that we would be working to. If it's never been used as a holiday let, then what you can do is obtain a letter from a suitably qualified agent, again to confirm that high, medium and low seasonal figures. And then what we can do is work from an average. So we can go from the average, or we can go from previous year's accounts. Or potentially, if it works, we can just go from AST rental income. So again, we have a very flexible approach as to working out the loan that we can get to when it comes to holiday lets. Just coming on to the next slide. So this product, a 5-2 product, as I mentioned at the beginning, we have got either 5-year fixed rates or 2-year fixed rates. Now, the 5-year fixed rates do come with ERCs during those 5 years, as does the 2-year product. But this 5-2 product allows for a 5-year fixed rate, so they've got the security of knowing what the rate's going to be for 5 years, but only has a 2-year ERC. And the beauty of this product is it just gives you more flexibility for your clients when markets can be, when markets are unstable and they're not sure whether or not they want to hold a security long term or sell it. At least in 2 years' time, they know if they then wanted to sell a property, they can do so without incurring any ERC charges. It also works really well if a landlord's purchased a security which they know potentially at some point in the future they want to develop, but it could take a while for that planning application to go through. So again, they could hold the security on the 5-year fixed, let it generate income for them whilst they're waiting for that planning application to go through. And then once that planning has been agreed, obviously if we're at the 2-year mark, again, they can refinance that off to development finance and go away and develop that security. So it really just gives you more flexibility and a different kind of product that you can offer to your clients. So along with all of the buy-to-lets that I mentioned, we can also consider lending on semi-commercial. So effectively where you've got that commercial unit on the ground floor with residential living accommodation above. All different types of tenants can be considered occupying the commercial element. again, we can go to 75% loan to value, and fees can be added above that. It's a manual underwriting process, so every case that you bring to us right from the outset will have eyes on it. So it's definitely not a kind of tick box, computer says yes or no. So it's a very, very manual process. Fixed rates again, starting from 4.8%, so really good rates on the semi-commercial. But there is a quirk for us, which the next slide probably explains it in a little bit more detail. As you'll see there, it says up to 40% commercial. This next slide really does kind of demonstrate what I mean by that. So if you can imagine a semi-commercial security with your commercial on the ground floor and the residential above, obviously the valuer is going to come to us and they're going to give us a value of that whole security. We also ask for them to give us a value on the commercial element and the residential element. And what we need is for the residential element of the security to hold at least 60% of the overall value. So for example, if the total security value is 300k, we need the residential element to come to at least 180,000, which is then 60% of the overall value. The reason for that is it does help us to keep our pricing a little bit keener, because the security itself is more weighted towards residential than it is to commercial. As I mentioned, we can consider all different types of different commercial tenants to occupy that commercial part of the security. That ranges from offices to shops, restaurants, takeaways, fast food outlets, beauty salons, hairdressers. We have done some dry cleaners where it's tenanted to a dry cleaner, and we have considered where you've got like the slot machine, so you know, all different types of tenants occupying on that commercial ground floor. Pubs, yes, if it's in a decent location, or a bar, you know, you could have somewhere like Brighton or London where actually, you know, that the demand for that flat above is really, really good. As long as it is all let out and there are tenants occupying both parts and it's not owner occupied, then we are really flexible on what's there on that ground floor. Okay. Now this is a bit of a hybrid product. Our refurb in term kind of sits somewhere between buy-to-let and between bridging, but this refurb in term is priced as our standard buy-to-lets are. So again, there is no loading to the rate whatsoever. Quite often you may have somebody approach you, they're looking to purchase a property, but they know that they just want to go in and do a little bit of work before they actually let that out to a tenant. So what we can allow on our term product is for them to go in and do any light refurbishment works, as long as it's done within 3 months of the term. It needs to be currently habitable, and the borrower needs to be experienced, and they do need to have the funds available to do the works, because what we do not do is go back in and then do another valuation. We literally lend on it day one, knowing that they're going to have 3 months of that security being vacant whilst the borrower goes in and does works to the property. So it does save you and your clients having to go down the bridging route. They can literally go straight onto a term product. So it's a really nice niche product, and again gives you another option for your borrowers. Bit of a recap then. So as I said, we can go up to 15 million. That is our maximum loan size. We can lend up to 75% with those arrangement fees being added on top. We've got no maximum age and no minimum income unless we're lending to those first time landlords. Fixed rates for 2 and 5 years. But something else that's probably worth mentioning is, as I said, I touched on the fact that everything is manually underwritten, which does mean you can kind of come to us with your quirky scenarios. And if we've got either a really strong borrower but maybe a slightly quirky security, or a really strong security, a low LTV, but maybe there's something a bit more quirky with the borrower, we can take a look at that deal and make a lending decision based on all parts of the deal that's presented to us. So I would probably describe us as being a very grey lender rather than black and white. So obviously the guys at Specialist know what we do, know what we can do. So the best thing to do is pick up the phone to them, give them the scenario that they can then obviously bring to ourselves. We can consider lending where the client may have slightly impaired credit, but what we're really looking for there is a very good explanation, and that will be done again on a case-by-case basis. But certainly pick up the phone to the guys at Specialist and they'll know whether or not it's one to put forward to ourselves. And that probably brings me to the end there, Tony, so thank you.
No, thank you, Sammi. Sorry, I clicked a little bit early there. I was a little bit premature, but I was going to go on to your next slide, which says, believe it or not, any questions. So
Any
we did
questions?
have two questions, but one, the delegate did then say ignore the question. So I will ignore that one. But thanks for asking anyway, Bavan. So Paula has asked, hi, Paula, how are you? Do you allow council tenancies, i.e. property given to the council, I presume that means rented to the council for 5 years on like a, some form of agreement, or commercial tenancies, i.e. a company takes on the property and lets out to asylum seekers, i.e. Serco?
Right. So in answer to the first part of the question, yes, we can consider where it's there's an agreement in place with the local authority, but we wouldn't consider if then the end tenant was classed in any way as being vulnerable. So where we've got the asylum seekers, that the tenants, that would then be a no, unfortunately.
Okay, that's always quite a tough one. There are lenders out there who will look at that, which we're well aware of, but it is quite a tough one. I think it's one of those things that eventually most lenders will probably do so, because there'll be some sort of law that says you can't discriminate against anybody. Like we had a while back, what was it? Most lenders would not lend to a certain tenant, housing association tenants, and then all of a sudden everybody was, because. But yeah, at this moment in time, it's a yes and a no, Paula. It is pretty much the answer. Jiwan has asked, what if the LTV for semi-commercial is 60%? Will it bring down the interest rate?
Yeah, so, well, we have 3 tiers of LTV. We've got 65, 70 and 75. So effectively at 60%, you're going to be the same rate as if you were at 65.
Okay, Jiwan, that it's within the, if you check the stuff that I sent over today, within the terms for Hampshire Trust, it's got the rate table within that, so it tells you exactly what it is. Paul has actually come back on that. Problem is the council will sometimes not tell you the tenant type, which is, unfortunately is always a problem. But
yes, so I suppose in that scenario, if those tenants are already in the security, we'd probably then be relying on the valuer to confirm. And if the valuer thought that it was vulnerable tenants, because quite often they will be able to tell, especially if there is, a care worker or someone like that also residing in the security, then that will have the alarm bells. It could be someone vulnerable. But otherwise, if we can't 100% say yes there is, we can't then 100% say no there isn't. So we'd have to literally take it at face value. And if we're being told the tenants are vulnerable, then obviously that's what we would go with, unless we determine otherwise.
Okay. There's no one typing at the moment. So here's the ones that you asked yourself, Sammi. So
okay.
Prepare. Are there any restrictions as to which countries expats, foreign nationals reside in?
So there aren't. Well, there's probably 3 or 4 countries that we would consider being very, very high risk. The obvious ones like Iran and Iraq. We've got a list of countries which have got a risk profile. So the higher the risk doesn't necessarily mean it's a no, but we just carry out additional due diligence. So the first things first is ask the question to you guys for ourselves. We can go away, have a look at that country profile and determine whether or not it's going to be a yes or a no. And that would be the same for where expats are residing and foreign nationals if we're lending to a foreign national in their own country.
Okay, final question. There's no others. So final question, do you limit the loan to value for foreign nationals residing outside the UK?
We will limit to 65% on those. So yes, in short, is the answer. So if you've got a foreign national residing outside of the UK, we can still consider lending, but it would be at a maximum 65% LTV.
Okay, expats?
Not for expats. So
not for expats.
We can go to 75. And if you've got, if we're lending to an offshore company, if we've got that onshore ultimate beneficial owner, then again, we can consider up to 75%.
Okay, right, Sammi, thank you. Really, for us, Dotty Hampshire Trust are quite a big part of our business, as you can imagine. We placed, it's close on, coming up to 100 million quid with them since 2016, a completed business. And they're the type of lender, quite simply, that sometimes, we all get them. We get that deal and you think, where do I start? I think, I don't know if you mentioned it, Sam, because I did have to pop out the office just whilst you was talking, but I caught the tail end of it. The one that we've just had offered for 7 million plus, which is a mixture of normal tenancies, there's protected tenancies, there's all sorts of stuff going on with this deal for basically an English guy who's retired to Israel. So it's a pretty complicated one, but that was offered last week, which I was very pleased to see. It's actually offered for more than what we originally applied for because evaluations came in higher. So client's extremely pleased because he'd been knocked back numerous times elsewhere with prior to it coming to us. So yeah, really, Hampshire Trust are an important part of our business, and I think we're probably an important part of their business as well now.
100%.
Yeah. So if you have anything, if you do get one of those deals, and you think, where the hell do I start? Just pick up the phone. I'm happy to take calls. The team are more than happy to take calls. They know far more than I do. The office that's next to me, far more I do about Hampshire Trust products. But we have at the moment probably 4 or 5 deals going through in excess of 3 million quid. And one of which, and we've got a little bit of time. We actually got a little bit of time at the moment because we are ahead of time. One of the clients, we did some finance for his mum, who unfortunately went through a bereavement. Her husband owned loads of properties. He committed suicide, unfortunately, and left loads of properties. And we arranged finance with Hampshire Trust just basically to get them away from the former lenders they were with. And his son's now applied to us for finance, and he wants to go with Hampshire Trust because he's so happy with the way they've worked with his mum. Although they're slightly more expensive than the mainstream, he wants the deal just over in one lump. So he wants one loan being taken against probably about a dozen properties that he's got, and he's more than happy to pay slightly extra purely because of the ease of dealing just with Hampshire Trust. So say at the moment, yeah, things are looking pretty good after what happened last year with many lenders, but especially HTB. So it's a big part of our business. Big part. So Sammi, thank you so much as always. Sammi was the first person to come and see us once restrictions were lifted. So so she tends to pop in normally once a month or so. So we'll see you again very soon. Okay.
We certainly will.
All right.
Looking forward to it.
I'll let Simon take you out as being a presenter. And yeah, see you in a while. Our next speaker, Emery Grundy, who is from West One. You probably all heard of West One. Been around a long time, and this is with regards to the second charge part of the market. So you should have received this morning in my email the current second charge mortgage range, which we've got for May 2021. There she is. Hi Marie, how are you?
I'm very well, thank you, Tony. How is everyone this morning?
Well, I'm fine. I don't know about everyone else. I'm sure they're absolutely fine, but yeah, I'm not doing too bad. So different hairstyle, I see. So.
Just longer, but problem with the arm, I see, Tony.
Yes, it's all right. Yeah, I won't go into it, but yeah, not a great time. Okay, so a little bit about Marie first of all, who I've known for donkey's years. I mean, when I say donkey, I do mean donkey's years. She joined West One as sales director. So here we have a director talking to you in 2017, and she oversees sales management, distribution, marketing, and product development for West One's second charge division. Marie has worked within the mortgage market for over 25 years, starting out as a graduate trainee for the Yorkshire Building Society. Prior to joining West One, Marie was managing director of a specialist distributor, V-Loans, giving Marie a unique insight into the market from both the perspective of broking and lending. Marie has also held senior positions within the specialist lending market over the last 17 years, including a board position within the Association of Mortgage Intermediaries, and I did vote for her for that one, by the way, and was also recently appointed onto the board of the newly launched Society of Mortgage Professionals. Now, her interesting fact, there's a bit more to this, and I was going to add some of the other stuff to it because there was some quite embarrassing stuff, but I couldn't find it, unfortunately. So the interesting fact is obviously following the theme of our presenters even being on TV or in some she once appeared in a Bryan Adams video. So which one was it?
Well, it's the bit where you have to pause it and then do it frame by frame for about 30 seconds. So I think you just, my hands go up in slow motion and back down again, and that's about it, really.
You was a dot in the background, was you? It's like that situation.
So
he wasn't really in it. He was just walking past as the video was being shot.
I was stalking him as usual. Yeah.
Right. Well, over to you, Marie. Now, Marie does have a habit of, and she's very passionate about this. She does have a habit of chatting on. So we have wired her chair up to the mains, and if she gets past 25 minutes, I'm flicking the switch. You might see her jump. So Marie, over to you. I won't waste any more time. Over to you, and I'll see you in 20 minutes.
Thank you, guys. Thank you very much, obviously, for having me again. Really appreciate being asked back to what is a very well-run event. So yes, basically, I'm the managing director of the second charge division for West One. So a brief introduction into West One. If you may well have come across us, we lend into different areas of the property finance and mortgage market. So very well ensconced within the bridging and development finance markets. We're the leading bridging lender in the UK. We've diversified into second charges around 4.5 years ago now. And more recently, we launched our buy-to-let mortgage division as well. So you may well be seeing West One crop up more in terms of sourcing systems, particularly around the buy-to-let mortgage stuff, which is growing really, really fast. We believe to be the fastest growing non-bank lender in the UK, and we were fortunate that we were able to continue actively lending throughout the pandemic as a very well-funded business with diversified funding lines. And all of our products can be accessed via specialist financial services. But what I obviously want to concentrate on today is the second charge market and looking at the opportunities, and particularly sort of in a post-pandemic world. So trying to really bring to life where borrower circumstances may well have changed, where a second charge may well be the best route for those borrowers. And I think it's fair to say that, you know, borrowers now more than ever really do rely on professionals like yourself to receive advice at a time where, you know, circumstances probably are more complex as a result of the pandemic. So advice is really key, which is why it's really important just to try and put across where a second charge might fall into that advice positioning. One area really is for borrowers whose credit profile has been affected by the pandemic. So there will be a proportion of customers who obviously struggled through loss of income throughout the pandemic and may well now not have access to mainstream finance in the same way. So that's one area which we'll touch upon. Clearly, it's really critical for you as advisors to regularly review client circumstances to make sure that they are in the best possible financial position. I mean, one area of second charge lending, which is a key feature, is debt consolidation. And what we see is borrowers coming to us who may well have, you know, had to rely, unfortunately, on credit cards when income was obviously affected during the pandemic. And it's just really about putting those borrowers into a better position, providing that is the right thing for them to do. But debt consolidation in the second charge world is all discharged directly to the creditors, which means that we don't have to take the debt consolidation into account as part of the affordability assessment if we are clearing that directly. So that is one area, again, where it may be more suitable for a borrower to achieve that through a second charge rather than a first charge. And we will end up to 85% as well for debt consolidation for unsecured credit. So just moving on to the next slide, bear with me. So why second charge is so relevant to you as advisors. And one area we found during the pandemic, which was a bit of a gap in the market, was that the time when there was a real lack of a supply of higher LTV mortgages. So there was, for first-time buyers who needed access to higher LTV mortgages at 90-95%, as we all know, there was a real issue around demand outstripping supply. So we introduced a Bank of Mum and Dad product, which has specific criteria for those parents or grandparents who are looking to support younger relatives looking to get onto the housing ladder. So that just means that sometimes as a blended rate, actually, it's better advised for the first-time buyer to take a 75% LTV product if mum and dad or grandparents want to support them by giving them a larger deposit to put towards that property. So that's something that we brought in, which we saw was an opportunity for the first and second charge market to work together more closely. We're also seeing more demand for second charges being used for property purchases. So whether that is a second home used as a holiday let, or it's an investment property. So quite often we can raise deposits towards a buy-to-let or an outright purchase. We're definitely seeing an increase in demand for that type of loan purpose. And we do offer loans up to £500,000. So sometimes these properties obviously can be higher value. So for higher net worth borrowers with large access to equity, then that's something definitely worth considering as well. Second charges are always used very regularly for home improvements, and we all know that during the pandemic, people looking to improve their own space, whether that's adding space to work from home or just to take the opportunity to make those improvements that they've been putting off for a little while. Home improvements are really something that we see all the time. And again, they can vary from small projects to, the installation of a kitchen or a bathroom, right through to major renovations for higher valued properties over £1 million. So we do see a really wide range and variation in the type of home improvement projects that we can help with. We are one of the few second charge lenders that also offer second charges for buy-to-let borrowers. So currently that's available for individual landlords and not currently for limited companies or SPVs. But we can lend up to £250,000 on our buy-to-let second charges, and they are used for a variety of purposes. So that can be for a further expansion of the property portfolio. It may well be that they want to use that money to refurbish their buy-to-let portfolio to improve rental yield or value. Or it could be for personal use as well. So we have a really wide range of loan purposes available, and it's all based on a simple debt service cover calculation. So that's something, again, we're seeing a lot more demand for right now. We're also seeing within the mortgage market a change in the structure in terms of there's a greater take-up of longer term fixed rates. We all know at the moment that there's a price war sort of going on within the first charge market as lenders are looking to attract new customers, particularly from a remortgage perspective. But we also know that product transfers are becoming more and more popular, and that really is an opportunity where, particularly where a lender has arranged that product transfer without the intervention of an intermediary. It quite often is done on an execution only basis. But what happens at that point is the borrower's additional immediate or future borrowing needs haven't really been addressed. I mean, I've heard recently that some of the bigger high street lenders are actually targeting borrowers midway through a 5-year fixed rate term at the moment to try and put them onto a new deal. And again, that is without the intervention of intermediaries. So this is quite an important point, really. I mean, the data available shows that in Q4 2020, product transfers were actually 4 times higher than remortgage transactions. So it's a market that's growing all the time. And again, it's a real great way for you to keep in touch with your clients and retain clients by making sure that you're keeping in touch with those guys, even if they have gone down the product transfer route with or without your advice and assistance. So that is something really that we're very conscious of right now. So how can second charges add value to your business? So the first thing to say is when it comes to second charges, there's no requirement for you to add charges. That's why firms like Tony's exist, because they are experts in this market and they understand what the different product propositions are for the different lenders and the criteria that supports that. So just by offering a second charge doesn't mean that you are on the hook for the advice, and you can outsource that to an expert. What it does do though is it extends your scope of service so that it does help you with client retention, because we've all got to think about the ways that we adapt our business, particularly in the post-pandemic world. Like I've just alluded to, quite often now there's a race between sort of high street lenders and broker firms to get to the customer first. So it's really important that you think of different ways that you can meet the changing needs of your borrowers. So it gives you a more holistic advice approach, and the potential of better customer outcomes as well, by not immediately moving towards a remortgage solution when a customer comes to you saying they need to raise some money. So that's something that that is worth bearing in mind. If you are an independent broker, so you describe yourself as an independent firm, then you must consider second charges alongside remortgage products, because you need to be able to offer a broad selection of products across the market. So that's something as well just to bear in mind. And then that would be an area where you would need to advise on second charges. In terms of the more traditional second charge opportunities, the main one really is allowing the first charge to remain in place and not disturbing any sort of preferential terms that may be available. So one obvious example of that are interest-only borrowers who may well struggle to retain their interest-only repayment vehicle if they were to remortgage, or even if they were to take out additional borrowing. Quite often, if they do that, they could well be forced to convert all the borrowing onto a repayment basis. And I've got a nice case study just to show you exactly what that can mean in terms of monetary terms of savings by considering a second charge in that instance. Another obvious example is where borrowers are in early repayment charges, so there's going to be a significant cost for them to repay their first charge just to raise some additional money. And the other one really is where a customer's situation has changed, so their credit profile may well have deteriorated. So if they've got a high street rate on a remortgage, they may well not have access to those type of interest rates. So again, may be worthwhile retaining the bulk of the borrowing on the high street rate and taking out any additional borrowing on a second charge basis. That said, second charge rates have fallen significantly over the last 5 or 6 years just because of increased competition within the market. So our rates start from 3.99, and quite often there's a misconception that second charge rates are really expensive, and actually then they're getting much closer to sort of further advanced rates, but I tend to be much quicker in terms of the completion times. One obvious benefit is that when a borrower takes out a second charge, they don't have to have a solicitor acting on their behalf. So there are no post-offer conveyancing requirements. The only time a solicitor is generally required is if there's a requirement for independent legal advice, for example. But it just means that, as you probably know as advisors, you can get a mortgage offer out pretty quickly. But if you're relying on a panel conveyancer to affect the completion of that transaction, that can add on another 4, 5, 6 weeks sometimes, depending on the service that's available from those panel conveyancers. So if speed's an issue, second charges are quite often the best option. There's also niche lending opportunities. So for example, if you have a property owned in one name and they've since got married or moved in with a partner and they want to add them onto the loan, we can do that if they've lived there for a minimum of 12 months and use their income towards the affordability assessment. Equally, if you have somebody who is married and has property in their own name and they don't want to add their partner to the loan, that's also something we can do. And we just take the additional adult into the household composition for affordability purposes and get a waiver form. But that's also something we can do, which is available only through a small number of second charge lenders. So I mentioned earlier about interest only, and this is a case study based on an interest only borrower with quite a large mortgage of 300,000 on a 5-year fixed rate at 1.75%. So their current monthly payment is £437.50, and they want to borrow an extra 50,000 for home improvements. So this particular lender has a policy where if they take out a further advance, they need to convert all their borrowing onto a repayment basis. So by borrowing the extra 50,000, it'd actually take their payment from £437.50 to £1,411 per month based on a 20-year term. So that additional 50,000 of borrowing is going to cost this borrower an extra £1,000 a month, which obviously doesn't seem like a great deal. So the other alternative is to leave the interest-only borrowing in place and retain that payment of £437.50 a month, and then take a second charge out for the additional 50,000 at a rate of 4.25% on a repayment basis over the remaining term of 20 years with a monthly payment of £309.62. So the total payment would be £747 as opposed to £1,400 a month, and that would effectively save the borrower £663 a month. So as you can see, that's a really good example of where a second charge would produce a much better outcome for that particular borrower if they did want to retain their interest-only borrowing. So just to sort of give you an overview of our residential loan range. So as I mentioned, we have rates starting from 3.99%, and we have a range of variable and fixed rate options. We can go up to 85% LTV for employed, self-employed and retired applicants. We can take up to 100% of regular overtime and commission into account, so providing we've got a track record of that and it's in line with the previous year's earnings, that's something that we can do. In terms of affordability, our affordability is based on an automated ONS expenditure assessment. So we look at the household composition. There are 3 areas of expenditure that we request, including council tax, and then we use that to determine what surplus income is available and whether the loan is affordable on that basis. And we have some products available that don't have an LTI restriction. So if you do need a higher income multiple, that is available through West One. We have loan sizes up to £500,000, up to a maximum LTV of 65%, but we can consider larger loans on referral as well. And we, like I said, we are starting to see a trend of sort of different borrower profiles coming to us that are, you know, earning significant amounts of money just where a second charge makes sense for them, and they may need access to larger loan sizes for property purchase or significant home improvement projects. We have loan terms available up to 30 years on our residential range, and we can also look to lend to older borrowers who are either approaching retirement or in retirement, providing the loans repaid up to their 85th birthday. And one benefit with all specialist lenders is that actually it's a bespoke underwriting service that we offer, so we can really take a deeper look into borrowers' individual circumstances. We don't use credit scoring, we use credit assessment. And quite a lot of the deals that we do are based on a referral basis, so they don't necessarily tick all the boxes from an underwriting policy point of view. But if we can look at the merits of the deal and see that we're putting the borrower in a better position and it's affordable over the term, then we always take consideration of those cases. So it's definitely worth speaking to Tony and the team if there are any more complex cases you need to discuss. Turning to our buy-to-let range, like I said, buy-to-let second charges are definitely increasing in popularity. I mean, as you're probably aware, most landlords now are taking rates over a 5-year period. Further advances are in shorter supply from buy-to-let providers. So there are quite a lot of opportunities for landlords to access further finance through a second charge. I touched earlier, obviously, on the reasons why a landlord may well want to take a second charge out, but just to bring that to life in terms of a case study on a recent completion. So we had a professional landlord who had a number of properties looking to add a further property to their portfolio. So they wanted 150,000 towards a property purchase. They had an existing first charge with a high street lender on a preferential rate, so remortgage wasn't appropriate. And like I said, our borrowers were experienced landlords. We could see that their property portfolio was being conducted well, so we could make the assessment that those properties were all self-financing. And because they're experienced landlords, it just meant that we could offer more streamlined processing requirements as well. So for these borrowers, we were able to arrange a £150,000 net loan on an interest-only basis, because interest-only is available through our buy-to-let range with a credible repayment strategy. And the exit strategy in this case was a sale of the security property, so the sale of buy-to-let. So that's a good example of a buy-to-let second charge. And we can do buy-to-let second charges up to 75% LTV. We've got rates starting from 5.99%, and that's available for consumer buy-to-let products as well. So we have the same rate, the same terms for CBTL products as we do for the unregulated buy-to-let. I obviously caught the end of the last presentation talking about DSS tenants. So we do lend to DSS tenants and tenants from housing associations on this basis as well. Loan sizes are available up to 250,000. And as I mentioned earlier, we do have really straightforward debt service cover calculations where it's 125, 145 or 165% of the payment, and we base that on the lower of either the AST or the rental income assessment that the valuer confirms. We can lend to portfolio landlords, as I've just described, but currently not to SPVs or limited companies. And we can also consider licensed HMOs and expats by referral as well. So that's something that, again, we're seeing an increased demand for, particularly around the HMO market. And we can do up to 3 loans per borrower, up to a maximum gross borrowing of 500,000. So if they have 2 or 3 properties that they want to release some equity from, we can do a multiple loan transaction for a single borrower, which can be quite useful, clearly. So just in summary, in terms of second charges, I really just would like to put the point across that it's really worthwhile having that within your scope of service so that you can make sure that you're looking at every best possible opportunity for borrowers looking to raise further capital. A second charge won't be right in every circumstance, but there are certain borrowers who would benefit from them who are not necessarily being offered them. And the point I always make to advisors is if you're not offering them, there's plenty of price comparison websites who then introduce deals to different broker firms who offer mortgages, who offer protection products, and all the things that you do to retain that client. So you just have to be careful to make sure that you're offering borrowers what they need. You've got the opportunity to put the deal through Tony at Specialist Financial Services. Like I say, experts in second charges. Tony's been around in this industry longer than I can even remember, and they know the market inside out. And it just means when time, resource, and capacity constraints cause you an issue, you can offload all the heavy lifting to Tony and the team, who can look after the client and make sure they get the loan in the quickest possible time. Speed of completion is really important, and there's lots of areas of niche lending within second charges that might help borrowers with more complex circumstances. So thank you very much for your time. I have tried to rattle through that so I don't get into trouble off Tony, but clearly if anybody's got any questions, I'd love to hear them.
Marie, thank you. That was brilliant. Listen to the entire presentation and wouldn't disagree with anything you say, anything at all. It's in a nutshell, that's the second charge market, and it's, well, there's so many reasons that second charges should be part of your product portfolio. If you're not offering them, seriously, there is some very decent money to be earned, and just helping your clients out. But also remember, like Marie said, there's plenty of money supermarket, etc., all of them now, a lot with the meerkats, and all of them offer second charges, and they're all being referred to master brokers, my most hated term, that will then be pumping your client for extra products. So it is something you really do need to add to your portfolio, because there's so many different uses for it. Okay, so we haven't got any questions. Paul only came back and said, because you was in Brian Adams' video that he was once in a Mars bar advert, which wasn't his best day. And since I read that, my stomach's been rumbling. So I wish I hadn't read it. So thanks, Paul. There are no questions. You only set yourself 2 questions, Marie. So obviously your presentation was so thorough that it was able to cover pretty much everything.
Yeah.
That's probably why we haven't got any questions, I suppose. But you said here, so you've got here, self-employed borrowers are finding it harder to access mortgage finance. So how can a second charge benefit the self-employed?
Yeah, I think it's quite topical at the moment. I see lots of headlines about self-employed borrowers being left behind because of the impact of the pandemic. So as a lender, we will ask for the last 2 years SA 302s, but we tend to work on the latest year. And if there is a variation of more than 25%, we might want to know a little bit more about it. But we do try to take quite a pragmatic view towards self-employed borrowers, particularly those who may have well taken grants out or accessed some support during the pandemic. We really do look at what's the business in. Yeah, that makes sense that obviously there was a loss of income during that period, and now we can see that they're back on track. Obviously, with the lockdown restrictions lifted, most people are in a much better position. So we do try and look at deals on an individual basis, and that really may well benefit borrowers like the self-employed at the moment who just need a closer attention to their individual circumstances that might not be available, on a pass-fail credit score analysis, which is generally what's available within the high street. So it's worth pointing out second charges are pretty helpful for self-employed borrowers right now.
Absolutely. Second question, how can mortgage intermediaries access West 1 second charge products?
Yes, so well, so you will see West 1. We are on all the major sourcing systems, so our products will appear on there for both buy-to-let mortgages and second charge products. But if you think, look, I'm going down the route of a second charge, the best thing to do is pick up the phone to Tony and the team and talk through the different circumstances, because they've got a huge panel of second charge lenders. They've got a whole of market panel, and they'll be able to know pretty quickly where is the best place to place that customer and get them the best rate available. And so it's our job to give Tony the best possible product proposition, which is what we try and work on a regular basis to make sure that's refreshed and meets the needs of different borrowers. But these guys know all the ins and outs of the market and can do the research for you, which is the bit that takes time. If you want to advise on it, you can do, and Tony can take care of the processing, so you don't have any pain involved in that, or just hand the whole thing across to Tony and the team, and they'll take care of everything. So, but it's not just our second charge products, it's our buy-to-let products, our bridging and our development products are all available through Specialist Financial Services.
That's right, as a packager as well. Just also to add, and this is probably because of the location of West 1 in regards to us, we are fairly close to each other. Yeah. 3 of the underwriters have actually worked for me in the past, which helps purely from a perspective of who you're dealing with straight away. And we all know how important it is sometimes when you're dealing with a lender that you have that sort of relationship already. Well, 3 of them were on my payroll. One of them was actually started working all the way back in 1997. So, that is absolutely such an advantage that we have, that I've got those people sitting in. Not that they do us any favours, of course, because those days have gone, of course. But it's very, very useful just to ensure that hopefully our cases are a little bit nearer the top of the pile when they're sorting out what they're doing that morning. Obviously, Marie's not going to be aware of that as managing director of the secured loans division. By the way, have you been promoted, Marie? Because I always thought you were sales director. I presume you've
so now I just look after the second charge division. So that's
well done.
Thank you. But just one point on that as well. Sorry, Tony, I know you need to move on, but 2 things. One is all our brokers have direct access to our underwriters. So like Tony mentions, if there is an issue, he can get on the phone directly to me, to the underwriting team. And we've quite often talked through cases, don't we, Tony, where we just need to take a bit more of an in-depth view of those. And secondly, the latest figures were out for the market today, and it's been an incredible recovery for the second charge market from, what was quite a depressing state of affairs immediately after the pandemic, down to about 21 million. And we've just exceeded 100 million in a month for the first time, sort of post-pandemic. So the market really is on fire. Lots of opportunities. Just bear that in mind, because I think the market's only going to continue growing. So hopefully, guys, you'll take something away from this morning on that topic.
Okay, and I'll be covering second charges a little bit later in my final presentation, everybody. So, Marie, thank you very much as always. Absolutely wonderful, and we'll catch up very soon, no doubt.
Yeah.
And our next speaker is Gaynor Morgan from Yorkshire, which Yorkshire Building Society, but Yorkshire Commercial Mortgages, which is their specialist division dealing on the commercial side of things. You should have this morning received this, dated August 2021, which is their basically panel, their products and process update, the latest one they've issued. Very, very useful lender, this, very useful indeed. So this is one, if commercial is something, or even some of the bigger buy-to-let stuff is something you receive, then I will pay attention to this one. A little bit on Gaynor, first of all. She's been with YBS, which was previously Norwich and Peterborough, for coming up to 17 years. She spent 10 years working in residential lending before moving into commercial lending, where she's been happily for nearly 7 years. She has experience in dealing with commercial investments, owner-occupied loans, corporate and personal buy-to-lets. Over the course of her years within the finance industry, Gaynor has enjoyed developing her knowledge and skill sets and has completed her CMAP Serer, I don't know how that's pronounced, DIP BB&C, and has recently passed DIP FA, which is pretty impressive, I must say. But not quite as impressive as this, actually. She's a second-degree black belt and has won numerous British, European, and world titles over the years, and has had the honour to travel around the world to do so. And Gaynor has also won Peterborough Sportswoman of the Year twice. So absolutely fantastic achievement. I know that Gaynor is actually, she was an attendee, and she's just disappeared. Okay, so we'll try and get her back, find out where she's gone. But she was there a second ago, and someone's changed something. What's going on? There she is. Right, that's my IT team changing things. All of a sudden, I was on the widescreen. I wasn't really quite sure why. Right, the presentation's just disappeared. So let me put that back on. Don't you just love it? Right, let's try that again. So, Gaynor, can you hear us? No, your microphone's off, I think, by the look of things.
Can you hear me now?
Yeah, I can hear you now. Perfectly. Right, okay. We will crack on. So I've done your introduction. I don't know if you caught any of that, but I was going to ask, actually, the secondary black belt, I can't remember what it's in. Is it?
It's freestyle karate and kickboxing.
Right, okay.
So, yeah.
For Gaynor, basically. Right, okay.
I do enjoy my sports, I can't lie.
Yep.
But I do have to ask before you disappear, Tony, because I wasn't on earlier. What happened to your arm?
I've had shoulder surgery.
Oh, okay.
Well, what I was told initially was a cyst, and then it came through as benign tumour, which apparently is the same thing, but my wife just saw the word tumour and then freaked out massively, as you can imagine. But that's been growing in my arm for about 20 years. So it's worn away part of my shoulder bones. So I had to have a bone graft. And I've now got a 9-inch scar from the top of my shoulder down to my armpit. So that was 3 weeks ago, and it's absolute agony. So
you're looking well. So.
I'm blagging this massively because of the drugs. So bear with me. If I fall asleep when I'm doing my final presentation, everyone, you know the reason why. Because I'm just not sleeping at night.
As long as it's not through mine, that's fine.
Yeah. I'll put your first slide on, Gaynor, and I'll see you in about 20 minutes.
Fab. Thanks very much. Afternoon, everybody. Firstly, thank you, Tony, obviously, for the introductions and the opportunity to speak to you and the team today. As Tony mentioned, my name is Gaynor, and I'm one of the relationship directors here at the Yorkshire Building Society. As also mentioned, I have been here now for sort of 17 years, 10 years within the residential team before moving to the commercial team sort of 7 years ago. I can honestly say that's probably been one of my biggest learning curves moving into commercial, and still learning every day. Again, as obviously Tony covered, I am a second dan freestyle karate and kickboxing. I've had the opportunity to compete around the world at various competitions doing that. Also a couple other quick facts about me just to break the ice. I also have a 2-year-old, and I recently completed a 130-mile charity bike ride from Peterborough to York. As you can see, I don't like to sit still for very often. During my 7 years within the commercial, I've seen many changes, not only in our business, but within the commercial sector. Obviously, probably none is more aggressive and fast-paced as what's occurred within the last 2 years. Up until sort of 2 years ago, we were also previously known as the N&P Commercial, and we rebranded to YBS Commercial in 2011. Well, 2 years ago, although we merged with them in 2011, we didn't do the rebranding until 2 years ago. As well as the rebranding, we have also expanded our presence and reach within the market by growing our commercial team. We established 3 new commercial hubs based in Birmingham, Manchester and Bristol, and that's to add to the hub that's already based here in Peterborough, where I'm based out of. As well as obviously introducing those hubs, we are still continuing the growth of the team and the growth of the business, and we are looking to recruit more relationship directors within those locations, which supports the society's appetite in order to grow the business and to obviously help our clients and customers. Like most of our competitors, we had to quickly adapt during the global pandemic, and this resulted in the society making some amendments to its lending criteria and policies at the time. Whilst we were conscious that we did need to protect the society, we were also still committed to ensuring we didn't have to fully withdraw from the market, and we're able still to provide products and facilities to our customers, just slightly obviously a reduced appetite than we would have liked. Fast forward to now, and I'm happy to say that a lot of the restrictions that we had put in place at the start of the pandemic have been reviewed and are continually being reviewed. with many of them sort of being lifted or restructured to be a bit more favourable as we're starting to come out the other side. This leads me to share with you all today where the society currently sits in and the types of products that we have in the market that's available. The availability of these products would be through Tony and the team at Specialist Finance, because we do have a select broker panel, but obviously Tony and the team can help you access those products if that's the avenue you want to go down. Just share a page on here. Okay. So society offers, we have many strings to our bows in terms of the facilities and the areas that we're able to offer. This includes sort of commercial investments, semi-commercial investments, owner-occupied, corporate buy-to-lets including multi-unit freehold blocks, large personal buy-to-lets and HMO products. You'll sort of see all of those on there, and the presentation will cover all the areas that we do. The society is able to consider loans from 500,000 up to £20 million. On page 5 of the slide, you'll be able to see sort of the actual exposure limits based on what type of customer that is presented to us in terms of the relationship and how long they've been with us. So you can obviously have a look a bit more in those. Tony has asked me to talk to you a bit more about specifically the commercial mortgages here at the YBS and the type of offerings that we can do in that area. Society is in the market for both investments and owner-occupied proposals. This is something that we have done for many years. It's not something that's new to us. All of the relationship directors that we have on board and the new ones that we're bringing in are all experienced and knowledgeable in these areas. All of our loans are individually priced and they're done on the merits of an application. We take a risk-based approach when looking at sort of the pricing, and that will take into consideration factors such as the loan amount, the loan to value, the location of the property and the type of security that it is, whether it's industrial, whether it's retail, the type of tenant that you've got there. Is it a blue chip tenant? Is it a local covenant? The lease and break options that are attached to the property, as well as taking into account the client, their background and their previous experience. Most of our variable products will be priced between 3.5 to 4.5 over the Bank of England base rate, and the facilities will be offered anywhere between 5 to 25 years. The term of the mortgage isn't reflected by the term of the commercial lease that's left in place. We do accept that in this day and age, it is uncommon to be able to secure sort of your 15, 20-year leases as historic. So we will just have a look at where the debt position will be at the first break or the end of lease and make sure that we're happy with that in terms of the position. Ideally, you're generally looking around sort of 60% loan to value at either first break or the end of the term. Loans can be considered up to 75% loan to value, although we do have some restrictions in place that would see us impose sort of a maximum 65%. Let me just move through the slide. Not very good at this tech here, apologise. So if you have a look on your screens at the moment, you will see sort of the different sectors in terms of the products. So offices, professional practices, you're looking at a 65% loan to value. If you're going sort of more industrial warehouses and storage, we can look up to 75% loan to value. Obviously, this is reflecting sort of the trait in the market at the moment. If it is a pure owner-occupied deal, and I say pure owner-occupied in terms of that the person buying the property or the company that's buying the property is also the person that's occupying, then you are restricted to 65% loan to value. If it is a opco-propco, so you've got an individual or a limited company buying the property and they're going to lease it to another one of their businesses, a subsidiary of the business, we would treat that as an investment as opposed to an owner-occupied. So we could consider still 75% if it's depending on sort of what sector it's in. Most of our commercial loans are on a capital and interest basis. However, the society is able to consider part and part or potentially a 5-10 year interest only facility, with the remainder of the loan then being done over a capital and interest basis. That wouldn't be available if the property was a pure retail or pure office. You would be restricted to capital and interest from day one. Repayment coverage is either 100% of pay rate plus 3.25% or 7.25%, whichever is the higher. That's for an investment purpose, and for a non-owner occupied, you're looking at the EBITDA to cover 100% of the same sort of factors. So pay rate plus 3.25% or 7.25%, whichever is the higher. If you've got somebody who's looking to occupy part of the property for their own business and rent out some of it, then we can also look to add the rent back in when factoring sort of the rental coverage. Again, we'll also look at adding in any add backs from their accounts, such as rent if they're paying that at another premises and they're coming out of it, as long as they can obviously easily exit that lease. Then we can look to factor that in when we're calculating the EBITDA. As well as our variable rate products, which obviously are on the screen, we have introduced 2 fixed rate products that are available for semi-commercial loans. I'll just jump back a screen. So you'll see on here that we have a 5-year fixed rate product, which is 4.35%, and that's for loans up to 70% loan to value. And then we have a 10-year fixed rate, which is 4.8% up to 65% loan to value. Both of those products offer an interest-only element for up to 10 years, with it then converting to capital and interest. And after the fixed rate period, it would convert to society's SVR. The main feature of these products is that it is driven by the capital value of the property as opposed to the rental income. So 50% or more from the capital value needs to come from the residential elements in order to qualify for those products. Outside of that, if they didn't, then they're still available to have a variable product, which I said, again, is based on the own merits of the deal, anywhere sort of between 3.5 to 4.5 over base. As it stands at the moment, we're not in the market for your hospitality and leisure sectors. So in terms of pubs, hotels, restaurants, it's not something that we were massive in lending on pre-COVID. And as a result of obviously COVID, we took the decision to withdraw from the market at the time for lending on those. It is an area we are looking to go back into. So hopefully by the end of the year or start next year, I can come back to you and say that that's also an avenue for us. We're generally not in the market for first-time landlords. Sort of seeking you more experienced, seasoned investors. It's not to say for the right deal, right proposal, right client that we wouldn't consider a first-time landlord. So if you do have anything like that, I suggest giving us a call beforehand. A few key points about our facilities, which covers sort of all the ranges here at the YBS. We don't insist on business banking. It's not a facility that we offer, so we don't insist that to have a deal with us, a client has to move their business banking to us. It's not a standard that we'll take a debenture where we're lending to a limited company. We understand the challenges around doing that for the customer and ourselves. We can lend to personal and corporate structures, as well as looking to lend to SIPs and SASs for your commercial deals. When lending to a limited company, we will look to take guarantees from the shareholders and directors involved. The level of the guarantee can be negotiated in line with the risk appetite of the particular deal. The term we can look to base on the youngest party. Typically, we go up to the age of 75. Again, there is wiggle room on that as and where the deal allows. We'll look to take first charge over the property along with assignment of rent for any occupational leases. Obviously, during the course of the mortgage, if the client does change tenants, then we'd just ask that they contact us to let us know the details so we can make sure that we're adequately secured. Lending is typically based on the lower of MV, VP or the purchase price. The only exception to that is if you're lending to a customer where the tenant in the property is a blue chip tenant. And we would define a blue chip tenant as somebody having a D&B rating of 5A1 above. So the likes of Wilko's, Sainsbury's, Tesco's, in terms of being blue chip. in that basis, we can then look to lend on the MV, providing we don't exceed 100% of the VP. Arrangement fees for all of our products are 1.5% of the loan amount, and we can look to add 1.25% to the loan, providing we don't exceed the loan to value restriction. Out of that, we do pay a 1% procuration fee to the introducers on the commercial deals. We operate a separate legal representative basis, so the clients will need to have their own solicitors as well as having use of our solicitors. Unfortunately, they do have to pay the cost of both of those. We lend in England and Wales, not currently in Scotland. One of, I'd say our USPs is that we are all contactable. We're available mobile, emails, and we have direct access to our underwriters. So if you do have something quirky, then we can obviously discuss that with them at the onset before sort of issuing heads of terms and asking you to send in full details. We're a bricks and mortar lender, so we'll take into consideration alternative use of a property, along with the desirability in terms of the relet and resale. Those are areas that we would be looking for a valuer to comment on in their reports. Lending, as I said, is generally based on the lower of the purchase price market or vacant possession value. I know that's just popped up as a question. And again, our valuers will be looking to provide us with the commentaries in those reports. We will also base lending on the lower of the passing rent or the market rent, again, as a sort of dictate by the valuer in his report. Many of you will probably still be questioning what lender stances are on CBILS loans, bounce back loans. I think it's fair to say that not one shoe doesn't fit all for customers that have been in those positions. We sort of will take a review of every application if a customer's gone through that, taking advantage of a CBILS loan. It's understanding sort of how their business has been impacted, how the loans have been used, and how they're coming out the other side of it. So just because somebody has had that, we wouldn't automatically penalise them for doing so. As a prudent lender, we look to understand the full mechanics behind not only the transaction, but the UBOs involved in that. So we are looking at the client's own personal asset and liabilities, along with details of their own sort of personal income and expenditure. We obviously want to make sure that the clients in the background are strong themselves to weather any storms. As I said, each application is looked at on its own merits and circumstances. Again, one shoe doesn't fit all. So one structure is not going to fit all. And we will obviously look at a loan that suits the client's needs as well as society's risk appetite. One of the key benefits of using YBS is the service that we pride ourselves on. We won the best service from a commercial mortgage provider at the Business Money Facts Awards in 2021. So whilst I wouldn't say that we're always going to be the cheapest in the pricing or the cheapest in sort of in terms of the fees, one thing that you will get from us is the service. At every stage of an application, you'll have a designated point of contact, whether that be myself at the initial onset of looking at the application and processing it, or whether that's one of our release officers who will see the case through to completion with the solicitors. On the back of that, any applications, as I said, would need to come through Tony and the team. We do have a select panel of lenders that we use. So we aren't open to everybody. Our products aren't available to every introducer. So anybody who's wanting to look to use those would need to come through Tony if they wanted to do that. I think that sorry if that's a bit quick and a bit sort of not as in depth about it. There's a lot that we do and a lot sort of in there. So obviously if anybody has any questions or any queries, then I'm more than happy to answer those.
Okay, I'm back on. Thank you, Gaynor. Excellent as always. Obviously I've got the questions that you set yourself, so I can ask it, but someone, it's come up. Okay. Do you want to ask a question again? Hello, Gaynor. Thanks for the presentation. Do we have product for semi-commercial where residential is not 50% plus of the capital value?
So fittingly, we're on the page on the presentation, which is good. So if you weren't fitting to have the 5-year or 10-year fixed rate product, then you would just be looking at one of our variable products, which would be sort of between 3.5 to 4.5 over base. There is another sort of factor on there, which you can see on the screen, that if 75% of the rental income comes from the residential element, so again, we're not talking capital value now, we're talking the rental, then we can look to go up to 75% loan to value, but it would be on a variable product. If it's less than 75%, it would be 65% loan to value on a variable product. But as I said, each product would be priced on a case-by-case assessment risk-based approach.
Okay. Right, so no more coming. Oh, someone is typing. Paul Rhodes' question was answered because I heard you answer that within the presentation. So this regarding the what's the LTV, open market or purchase price, which you covered. Are you just a commercial lender?
So no, as I said, sort of at the onset, we do a lot more than just commercial. So buy-to-let, HMOs, holiday lets. We can look to consider large personal buy-to-lets. Obviously, I've not covered in detail about those because obviously sort of a bit more commercial based for you guys today. But we are more sort of, there is more to us than just commercial. So again, obviously Tony can share with you the full presentation. And obviously you can speak with Tony about what exact deals that we have on offer.
Okay. Would you lend to offshore companies or expats?
No, so we are, I'm afraid, just UK based. So the UBOs as well as the limited companies or corporate entities do need to be based in the UK.
Okay. Can you lend to SIPs and, I never pronounce this bit, SASs with two S's?
Yes, we can. So yeah, that's fine. Not a problem. Obviously, we'll be governed by the pension rules. 50% sort of lending they can only gear up by. But yes, happy to lend to those. Okay.
Will you consider owner occupied loans?
Yep, owner occupied is fine. As I said, if it's a true owner occupied, you're 65% loan to value. If it's a quasi owner occupied, we can look to do sort of up to 75%, depending on the type of asset that's involved.
Okay. And do you consider adverse lending?
No. I say no. We are generally a vanilla lender. Again, I understand things happen in people's lives. I'd be foolish to sit here and say everybody's always going to be, nothing's going to crop up at any time. So what I would say is if you do have something that is on somebody's credit file against a business, I would prefer a phone call ahead of an application just to have a chat about it and see whether it's something we can look to do. Okay.
And Jiwan's asked a question. He is directly authorised and he wants to know if you guys are on panel with Legal and General and Paradigm. I've absolutely no idea, but you're on panel with us. So
yes, yeah. So yeah, so no, we're not with those. As I said, we are sort of with Tony and the team. So if you did want to do any applications, then it would be going through Tony and the team to reach to us.
Yeah, pretty much with explaining the Yorkshire Building Society situation, we was invited back onto panel. I'm not sure if it's 2019 or 2020 with what's gone on over the last year or so. We was invited back on, and then it was probably one of the most stringent processes I've ever come across to get on a lenders panel. It was like applying for FCA authorization all over again, but we passed, and so it is a tough one. They don't deal with a huge amount of intermediaries purely because then they can't cater for, obviously, for that type of situation. So they just tend to, their preferred route is to a limited number that can then spread the word, like we are today, for example, as to what's available. Of course, if it was someone like Legal and General or Paradigm, they would probably pay you as quickly as we would, and we would pay you more as well. So
I think with Legal and General and that they're more of mortgage clubs, aren't they? So we're not sort of a mortgage club lender. We're
exactly
introducer based. As Tony said, we don't have a massive number of introducers on our panel. We probably have about 130. And yes, part of it is down to being able to sort of cater for the number of introducers, but it's also about building a relationship with our introducers. We sort of don't want to be back where we were probably 4 or 5 years ago, where we've got 500 people on the panel and you get an application from somebody once every 5 years and they don't know how you work. We don't know how they work. And it's probably not the easiest and smoothest process for a customer. So having the direct relationship with a smaller number of introducers means we can provide a better service all round for all parties.
And it is absolutely the case. There was a situation a few years ago where a commercial lender launched out to everybody that had interim FCA permissions, which was about 9,000 people. and then found that their service had their inbound call volume increased by 900%, and they had their underwriters taking phone calls on commercial deals and being asked questions like, what is a lease? And that's literally how bad, and they then had to very quickly try and get back to where they were, because it's just a massive mistake. While their director decided, let's deal with everybody, not understanding the implications of doing that. He then left shortly afterwards. So yeah, as far as it's a sensible way of doing things, small panel, but yeah, dealing with people that can spread the word. And G1's just come back, so I need to get on panel with Tony. Absolutely, I'll get one of my team to give you a call this afternoon as soon as we finished. So. Right, so Gaynor ahead of schedule, absolutely fabulous. Thank you very much as always.
Right. Thanks very much for
Take care of yourself. We'll talk again soon.
All right, bye guys, bye.
Cheers, bye.